Welcome to Longview Conversations with. This is our Longview podcast where we interview finance experts from around the world with different market backgrounds and different areas of expertise. This is our 10th episode. In prior episodes, we've interviewed all sorts of fascinating characters, had very good conversations with the likes of Andrew Hunt of Hunt Economics, a global economist, with Jonathan Payne from Australia, who spent many decades being a global strategist and economist across the world. With David Murren, a global forecaster, we discuss World War III, Kondratiev waves and bear markets. I've interviewed Gilliam Tullock, where we had a deep dive conversation about Chinese accounting. We've had long discussions about the Chinese economy. I've discussed much with geopoliticists like Mike O'Sullivan, author of The Leveling, and Wolfgang Munchau, former FT European editor. So it's in that vein that I'm delighted to introduce our next guest, Jesse Felder. Jesse's had a long career in finance, and we'll dig into that as we get into the conversation, but he's author of the Felder Report, host of the podcast Super Investors and the Art of Worldly Wisdom, and very big presence on Twitter, as I'm sure you're aware. So it was a privilege to speak with Jesse. I hope you enjoy the conversation. Welcome, Jesse. Great to have you on the show. I really appreciate it, and looking forward to hearing what you have to say, talking to you about markets.
Well, thanks for having me, Chris. I'm excited to do this. I'm something I've been looking forward to. So, thanks for having me.
Absolute pleasure. So, let's start by getting you to explain your background to the audience. Your career, your love of markets, where it's all come from. Take us through all that. That'd be fantastic.
Sure. Yeah, my interest in markets actually started back when I was really pretty young. I think, I'll probably date myself, but my dad bought like the first Apple personal computer, or one of the first ones.
Wow.
It was I think the Apple IIe, and we had a modem.
What year was that,
and
Jesse? What year was that?
This would have been 1982.
I was thinking it must be sometime back then.
Right.
Yeah, fantastic.
Yeah, and so he wanted to get me interested in computers, and so he got me a couple of games, and one of them was a stock market simulator, and it was, you can look it up on YouTube. It's the worst video game ever created. It's called Millionaire, and you pick these hypothetical stocks, and it chunks along and tells you what the stocks do. But after that,
do you remember any? Sorry to interrupt. Do you remember any of the stocks you picked? Surely
no,
not.
because they weren't real companies. It was a totally hypothetical game, but it did get me interested in markets to the point that my dad got me a subscription to Barron's, and I would look up different quotes, in the pages of Barron's every week, and I started writing them down every
Wow.
week. So this was been, I was kind of elementary school age. And if I had been, understood what charting was back then, I probably would have been hand charting, some of these stocks.
Yeah.
But it was like Coca-Cola and McDonald's and things that brands that I was aware of as a kid. And so when I graduated from college, I thought, this is something I've always had an interest in. Why don't I go into this? Look at going into this field, and I was lucky enough to get hired at Bear Stearns in their Los Angeles office. He sent me back to New York to kind of meet the folks in New York and take a tour of their, meet the floor traders and the floor of the New York Stock Exchange, and it was kind of welcome to Wall Street for me. And I went to work for a gentleman at Bear Stearns who was basically running kind of a hedge fund within Bear, and a number of separate accounts, and quickly learned the ropes. We ended up a few years later leaving Bear and starting our own hedge fund firm. We started 3 hedge funds, a long short fund, a short only fund, and an income focused fund. And we were a person
what year
operation.
Would that have been?
So,
what year would that have been? Sorry to interrupt, but
that
what
was
year?
1997.
Yeah.
And it was interesting to start a short only fund in the late 90s, right? And operate that through 1999 was quite an experience. I was the head trader. Like I mentioned, we were a 4-person operation. And so I had a front row seat. Actually had, a couple other New York-based hedge funds that were trading through my trading desk. And so through to do that kind of through the peak of the dot-com mania was quite an experience.
That must have been very tough because I remember those days very well. I mean, I was at Cazenove in London, which Europe was caught up in the TMT bubble at the same time, and I remember the sales guys I used to do what was called the runners and riders in the stocks that were going from the 250 into the 100 of the FTSE. And they'd literally, the European sales guys, I remember, come to me and say, look, just give me any names with tech in it. That's all I want to know. I don't want to know anything else. And
Right.
they would pitch them to their clients who would buy them simply because they had the name tech in them. And
Right.
sure enough, they typically went from the FTSE 250 to the 100. And so
Yeah.
so if you're running a long short hedge fund, unless obviously everything's overly valued, how do you yeah, because I know historically you're a value investor, and we'll get into that.
Right.
But how on
And
earth
that
do you
was
cope with
our
that?
mandate. We had a value mandate, which was, very, very difficult. And part of the reason why I left the firm, I literally quit in the middle of March of 2000, right at the top of the NASDAQ, when the NASDAQ blew off and reversed lower. I didn't plan it that way, but I think, it was just natural that, tensions kind of built to that point, and that was a natural kind of time where I had been getting into arguments with my partner over abandoning our mandate, right? And that was
Right.
really, I think, for a lot of investors, the only way to survive. Is like, okay, we cannot keep buying these stocks trading 5-6 times earnings and trying to short things that are, going to the moon. And so we had for months in the fund, been arguing over the direction of the fund. And my partner was putting a lot of names in the portfolio, Red Hat and things that were, clearly not value
Chasing
names.
them, the momentum,
Right, right.
right.
And
Yeah.
thought, yeah, I just got to the point where, okay, I can't endorse this approach any longer. And left.
Tell me, has the last up until sort of mid-July, did the first half of this year remind you of at all of TMT? Did you have any flashbacks, parallels, etc.? It certainly
Oh,
seemed that
I
way
mean,
in many
yeah, absolutely. As you mentioned,
ways.
anything with tech in its name back then, was, or your internet or .com, was hot stock and would go up. And so when you see that, right, I mean, we saw it a few years ago with people putting crypto in their company names, changing from, whatever Long Island Tea Company to something crypto, just to kind
Yeah.
of draw investor interest. And we've seen that over the last, 18 months with this AI boom. Anything, companies mentioning AI and just trying to associate themselves with, large language models and these things has helped boost stock prices. It absolutely is reminiscent of what drove the dot-com bubble back in the late 90s. So I absolutely think there's parallels. There's a big difference too, that I think people are quick to point out that NVIDIA is a very profitable business and
Yeah.
growing sales very, very rapidly. So, and that can be said for all of the Magnificent Seven names. They're all fabulously profitable companies. Now, whether they're able to sustain the growth that they've seen, and whether the valuations today can be supported by that growth is an open question. But I do think there are a lot of parallel. I mean, history rhymes, right? Right. It doesn't
Yeah.
repeat, but it rhymes. And I think in a lot of ways it's rhyming right now.
Yeah, and it sure seems to rhyme a lot in financial markets. So much more we could dig into, and we'll come back to on that. But so
Sure.
2000, March 2000, you left, and then what?
Yeah, I mean, that's when my son was born in late 1999. He was a millennium baby, and we decided, we were living in Los Angeles at the time, decided to raise a family, we'd rather do that somewhere outside of the city. So we ended up moving here to Oregon and raised a family. And professionally during that time, I basically just managed my own money and some friends and family money for a number of years until about 2005. I was living in Bend, Oregon at the time, and I think in that 2005 timeframe, statistically, Bend became the number 1 or 2 most overvalued real estate market in the United States. And so,
Wow.
once again, I had a front row seat to a bubble, speculative
Yeah.
mania. And we'd go to barbecues and stuff at friends' houses, and literally the only thing people could talk about was how much home equity have you pulled out of your primary residence, and how many homes have you parlayed that into on a
Yeah.
speculative basis. And I literally knew people that had taken home equity out of their primary residence and parlayed it into 12 spec homes
Yeah.
in Little Bend, Oregon.
Extraordinary.
Under the
And
belief that home prices could only ever go higher, and the gains that we'd seen over the previous few years were sustainable.
it's amazing, isn't it? And hopefully, when you move to Bend, Oregon, you bought a property. Would be my
Yeah. Yes, but I actually sold it in 2000. So it was funny. I bought one in 2000, and I ended up selling it in 2004, 5. I bought another house in 2005 and sold it 9 months later at a 40% profit, right, in 9 months, and
Amazing.
said, okay, this is insane. I'm going to rent for as long as my family will tolerate it, right? I had 2 young children, but I just could not, stomach, having, money tied up in
The
that
question
market.
is, when you sold to rent, where did you stick the housing equity, the cash that you had? Did you? I have a couple of friends who sold at that time, bought gold, which I thought was quite punchy.
Right. No, I didn't buy gold. I just, was basically had it in cash, kind of waiting, because I knew we wanted to buy a house again at some point. After the market turned, it always takes longer than you expect, and it wasn't until late 2007 that home prices really started weakening, and then into the financial crisis. Obviously, foreclosures and things, 2011, 12 was really the time to get aggressive in residential real
Yeah.
estate. But that 2005 period was so reminiscent to me of the 90s dot-com bubble that's when I started writing about markets, and I needed an outlet for what I was witnessing. And so I
Yeah.
started a blog in 2005, just kind of writing about markets and things, and that eventually turned into 10 years later, 2015, the Felder Report, which is the research product I've been publishing for almost a decade now.
And that's kind of where you've been since then, of course, writing that and blogging and investing your own money and other people's money as well, more recently, or primarily just your own.
No, it's just my own money, and the research that I publish.
Yeah, yeah, and of course the podcast, which is fantastic and
I
well
appreciate
worth
that.
listening to. Super Investors and the Art of Worldly Wisdom.
Right.
And in that vein, actually, I wanted to ask you, because as I explained to you before we got going, I listened to your first podcast, which was a description of your, I suppose your passion and where you've been and where you're coming from, and why you set the podcast up more specifically. And in it, you talk about wanting to ask others about how they go about investing and what's inspired their process, and to quote you, digging into what makes them unique. So I have to ask you this question, Jesse: what makes you unique?
Well, I think it's that I look at myself as a jack of all trades, master of none. Really, is that I have a broad. I try and bring a broad number of different methodologies and perspectives to my approach. Obviously, I started as a value investor. The margin of safety concept from Ben Graham, I think, is very valuable foundation. But there's so many different ways to make money in the markets, and this is really where my interest in starting the podcast came from. Is you have to find um, different strategies and techniques and things that suit your own temperament. And I think for me, that's really what I've done. So I've incorporated technical analysis and a study, of momentum to kind of bring to the value approach to kind of balance out, some of the vulnerabilities of being a value investor. But I'm also fascinated by macro and a number of other things. And so I try and bring together kind of a breadth of different studies that kind of create a holistic approach to viewing the markets. And I think that is, to me, what suits my temperament and makes me feel like I have obviously not a complete approach. I don't think there's ever such a thing, but a balanced approach to kind of approaching capital allocation and markets and these sort of things.
That's interesting, and we'll get into all of that. And I suppose, and actually, I agree with you. I think it's very important to try and bring various disciplines to bear on your investing process. And I'm sure we'll get into the idea of value traps and the idea of momentum countering that. I just wonder though, because the challenge we have, we're macro guys, and but we like to look at technicals and we like to look at risk appetite analysis and other things like that, valuation and so on. But I think the challenge is you've got to get good at everything when you do that. When you have various different approaches. So, for example, macro, which that's kind of our thing. Value investing, I think, was originally your thing, and macro is something that you've grafted on. A macro is a deeply confusing topic. I always think there's as many opinions as there is people out there. So how do you graft that on? Because I've spent my entire working career looking at macro, and I feel like I've got somewhere, but I think it would be very, very hard to be confident in what you're doing. Maybe there's some simple ways of doing it.
Yeah, I think for me, it's always kind of a focus on the big picture. I want to try and understand what type of environment are we operating in, and I think that's where macro can be especially helpful, right? What is the shape of the yield curve, right? Can kind of tell you generally what part of the cycle you're likely in, right? I mean, so there are things like that. I mean, what is the direction of the unemployment rate? These kinds of big picture things kind of help you. I know that Howard Marks likes to talk about sentiment and how that taking the temperature of the market can be helpful, and just not necessarily in timing the market all the time, right? But it certainly can give you a good idea of, are we more likely to be in an environment where risk appetites are going to turn positive and drive the market higher, or our risk appetites already kind of through the roof and we're potentially witnessing kind of a speculative blow off type of a thing. So I kind of look at macro in the same way that I would look at sentiment, in terms of recently, one thing that I'm looking at is just kind of the direction of the dollar, the likely direction of the dollar. You look at things like purchasing power parity and whatnot, and it appears that the dollar is about as overvalued relative to major trading partners as it's been. And historically, that's kind of suggested that the trend in the dollar over the next 5-10 years is likely to be lower. What do you in a dollar bear market environment, what makes sense? And it's you think about things like more we talked about last week, Jeff Curry talking about this theme of the revenge of the old economy, and commodities and these types of things are likely to do better in a dollar bear market probably than financial assets and what have you, that have done really well over the period of the dollar bull market over the past decade. So I think generally for me, it's more of like, I want to take a macro temperature, and what does this kind of say towards where we are in the cycle, where we are in terms of favoring assets, different asset classes and those types of things.
I like that, I suppose, and we look at a lot of that stuff. I suppose the thing that I think is a challenge for those kind of indicators, and you mentioned the sort of inversion of the yield curve, and pretty much every recession's had an inversion. Well, every recession since the 70s had an inversion before the recession. But the question is the timing, because the dollar can be expensive for many years, or it can be cheap for many years, and also for many years it's in between. So you've got to decide if you want to go with the momentum, or equally the yield curve can be inverted for sort of 5 or 6 months before the recession, or really for almost 2 years. So that's great if you're a 10-year investor.
Yeah.
But even then, it doesn't help you time. So how do you finesse from that?
I think that's a great question. I think that those kind of things are, my friend Tom McClellan likes to say, a lot of these things are conditions, right? They're not necessarily triggers or buy or sell signals, but there's telling you that there's a certain condition in the market. And you really want to pair those with other types of indicators. So those types of macro signals I would look at to pair with some type of technical signals, like yield curves inverted, but, is it being, it's really that it, when it uninverts, that you really, the recession is arrived, and we're getting close on the twos, tens yield curve. So, that's something I'm paying close attention to. But I also want to, watch other things. So like the inside of the stock market is one thing that I pay close attention to. Stan Druckenmiller said it's the single best economist he's ever seen, is the inside of the stock market. What is that? It's the relative performance of those economically sensitive sectors within the stock market. What is the materials sector doing? What is retail doing? What are small caps doing relative to the S&P 500? And so I think you can look at Dow theory. What are the transports doing relative to the industrials? And so when you have a lot of these kind of signals start to confirm one another, and like I mentioned, the potential uninversion of the yield curve, we have a Dow theory non-confirmation, right? Transports have not been able to make a new high, even though the industrials are making a new high. The relative performance of small caps until very recently has been very weak. Retail's been weak. Materials have been weak. Transportation stocks have been weak. A lot of those things are all kind of pointing in the same direction. And so, I don't really have one indicator that I think is the be all end all. It's really kind of putting a lot of those things together. And, I think we'll get to it eventually, but, if there was one indicator that I would put above all of them, it's the aggregate of insider activity
Yes.
in
Well,
shares.
let's come back to that in a sec, because that's a fascinating indicator. So I'm with you. There's a lot of things you can put into the sort of boiling pot. And I totally agree. There's a lot, you've got to sort of take the condition of the market, read the temperature, as I think is you're describing it, and take a whole bunch of inputs. Do you in any way systemize that, or is it more that there's where you're going and your brain takes you there, and you're looking at this, that, and t'other? But are you sort of systematic in your approach? These are the 10 things I want to look at, and the 10 things I want to see 6 or 7 tick the box, or whatever it might be.
Yeah. No, I'm not. I'm not systematic or quantitative. I in any respect, I've kind of looked at things that way, but as we
don't think
mentioned
you have
before,
to. I
think
really don't think you have to.
History doesn't repeat. It rhymes. And so, like right now, there's a lot of technical science that I'm looking at in the market that are very troublesome. Over the past couple of months, breadth has been, we've seen record breadth warnings in the stock market. But the advanced decline line has made new highs. And so, if you are to systematize that, the advanced decline line making new highs might not make you as cautious as you'd otherwise be. But every one of these examples, throughout history, I think it's very difficult to say everything needs to we need to check all the boxes in order to see things go the way we expect. And so those technical warning signs to me, and I'm speaking mainly of things like the Titanic syndrome and Hindenburg omens, which we in the Nasdaq through the first 6 months of this year, we saw it triggered 25 Hindenburg omens. And in the past, whenever we've seen 12 or 13 Hindenburg omens, you've seen at least a 20% drawdown in the Nasdaq. So we've never seen 25 before in a 6-month period. So to me, that's a very clear technical sign that the breadth in the stock market is waving the red flag. There's a problem here. And so to me, that's something that I've watched very carefully over the course of my career. And that alone kind of confirms the idea of all the macro stuff too. That, yeah, when you start to see all of, the macro kind of point to higher risk environment, risk of recession, and then you get these types of breadth warnings in the stock market. It's the stock market kind of confirming, even though the major indexes are still near highs, under the surface, you have these breadth signals that are kind of confirming the idea that things aren't nearly as healthy as they should be. So yeah, I really do think it's probably more art than science in the way that I approach it.
Well, I think that's sensible, actually. I have many clients who run money around the world who systemize their thinking. And I agree with you. It is an art, much more than a science. And actually, the market feel and experience is really, really important in that respect. And it's like your sort of subconscious almost is turning a light on and prodding you when you see these technical signs happening in markets, the breakdown in breadth or the Hindenburg repeating or whatever it is. So I have a lot of sympathy with the idea that one shouldn't be overly systemized. I guess in one's head, one has a framework and so on. So it's interesting you mention all these indicators that are sort of triggering at the moment, because I've been sort of running around the world telling people that July the 11th was the most important day in the last 2 months. As the US CPI day, we had that major rotation. You remember the NASDAQ was off 2 or 3, Russell was up plus 2 or 3, and there was that big, and then we got a Russell breadth thrust in the next couple of weeks. It was almost like, bang, the cyclicals were off, the rotation within the market. You talked about the stock market internals telling you what's going on in terms of the macro. But on the flip side, you mentioned a lot of signals where you might be concerned about the market or the macro in general. So where are we at the moment? If you had to articulate the market today and where you see it going over the next 3, 6, 9 months, how would you describe it?
Well, I think, my friend Todd Harrison, who, from Minionville fame, he's much more focused on the cannabis markets today, but Minionville was a wonderful platform 20 years ago that, I learned a ton from Todd and the network that he put together there. I met Tom DeMark through Todd and learned about, trend exhaustion indicators and these types of things. And Todd liked to talk about the 4 legs of the trading table, fundamentals, technicals, sentiment, and macro. And so if we just start with fundamentals, and you look at the price to earnings ratio, if you want to look at a forward PE ratio, we're trading over 20 times. The Magnificent 7 stocks are trading closer to 35, 40 times earnings in aggregate. When you look at their free cash flow, they trade, the Magnificent 7 trade in aggregate 50 times their free cash flow. And that's a problem when they're spending so massively on this CapEx build out. And it doesn't, there's really no sign that it's going to generate the types of returns that investors might, demand to pay a 50 multiple of free cash flow. So from a fundamental standpoint, I think we are very much on the overvalued side of things. And if you look at things like the Buffett Yardstick, market cap to GDP, we're at all-time highs. And we've never been more overvalued than we are today. But if you take where we are in terms of the earnings cycle, I do think, it looks like estimates are for earnings growth to continue and to expand next year and driven by, record profitability. I think there's, when you look at these Magnificent 7 stocks, the peak in earnings growth happened in the first half of this year, and earnings growth is now decelerating. This is what we're seeing with NVIDIA reporting. And typically when you see this, multiples go up when earnings growth is accelerating, multiples contract when earnings growth is decelerating. There's a very clear relationship, even with the Magnificent 7 over the past 10 years. So now that earnings growth is decelerating clearly for this group, in trading 40 times earnings, I think, you just take the big 3, Apple, the $3 trillion names, Microsoft, Apple, NVIDIA, they're trading 40 times earnings. Historically, if they're going to grow at, 10% instead of 20%, a 20, 25 multiple forward might make more sense for those stocks. So that's some pretty big potential downside in terms of the multiple if earnings growth is indeed going to decelerate. And I think, there's reason to believe it could be, disappoint relative to those expectations. So
Yeah,
that's the fundamental
that's
picture.
really.
Technicals, go ahead.
Well, I was going to interrupt you before
Yeah,
we get on to the other points, because I'll just you make a great point about the fundamentals, because one of the chart, and we'll put it up on the screen as later on, is one of the charts that's great, I think, is if at the Magnificent Seven's earnings growth versus the S&P 493, and it
right.
shows that very point you articulated, with the Mag 7 slowing, and actually the S&P 493, the rest of the S&P 500, accelerating faster and going above the earnings growth rate in 2025, according to the analysts' expectations of the Mag 7, which I think kind of speaks to your point, which I concur with, a very expensive sector. And as you say, as their earnings growth slow, there's every chance they'll start derating from very rich valuations. So I'm interested. I agree with that. Let me just push back on one point on valuation, though, before we get on to the other three legs of the table, if you like, which is the Buffett point. I couldn't disagree more. The Buffett indicator's extreme highs. Again, we'll flash the chart up as we're talking about it. I forget what exact number it is, but it's of course it's the market cap to the US GDP, I think is the way it works.
Yeah.
And of course, Buffett's idea is that part of GDP's profits. So there's a relationship between the market cap and profits, and there's a limit to how much you want a market cap relative to profits. It's like a PE ratio for the economy. But all of these valuation indicators, Buffett, Shiller PE ratio, which has a similar type of concept, even the S&P 500 forward PE ratio, timing markets with it is exceptionally difficult.
Right.
And I suspect for you, it's probably one of your condition indicators.
Yeah, it's not a timing tool by any respect. To me, I look at it as potential risk versus reward, right? What's the potential reward here? What's the opportunity for multiple expansion, right? It's nil, unless you think we're going to, go further into record territory. What is the potential downside for reversion in valuations? And it's significant. So, the risk reward in terms of just valuation suggests potential reward is limited, potential risk is elevated. And I think that's kind of where it's valuable.
Okay, so that probably takes us that takes on the second stool onto the technicals, which perhaps gives you some better timing insights.
Absolutely. And so this is where, I mentioned, things like the breadth in signals that I've seen. It's the Titanic, we've seen a number of Titanic syndromes. Whenever we've seen these and these are, I should explain the way that these things are triggered.
Would be good. That would be good, because I've heard of everything else you've talked about, but not the Titanic. This is a new one to me.
The Titanic
I'm excited.
Very similar to the Hindenburg omen. You have the index at a new high or within a very small range of a new high, and the number of new lows is above a threshold, similar to the Hindenburg omen, or number of new lows is actually greater than new highs. And so when markets are at new highs, you should not be seeing a large number of components making new lows. And so that's all it is. When you have Titanic syndrome triggered or the Hindenburg omen, it's basically telling you the number of new lows is growing above a threshold that suggests the market is not as healthy as the price alone of the index would suggest. And so over the last 30 years, whenever you've seen these types of signals, and a lot of people say, oh, wow, the Hindenburg omen triggered. Well, one signal, matters not at all to me, right? It was created as, potential indicator of a crash. These individual signals don't work very well at all. But when you see, over a look back period, you see a number of them triggered. They're very consistent in terms of the forward returns, what you should expect over the next 6, 12, 18 months. And whenever we've seen these types of things, these levels, it's been a really good indicator that market is potentially topping and going to go into a corrective phase, if not a bear phase. And so from that technical standpoint, we have these breadth warnings that are significant, in some respects more significant than anything we've seen, even going back beyond the dot-com bubble. And then you have a number of like, I think DeMarc's sequential trend exhaustion indicators across a number of timeframes over the last week or two through this S&P 500 rally. We saw a sell setup 9 and a sell countdown 13 triggered in the S&P 500. But more importantly, we've seen on a monthly time frame a 9-13-9 sell signal triggered in the S&P 500 as it's formed this monthly candlestick, which you might call a hanging man or a dragonfly doji, which is pretty rare type of candlestick.
So is that on, just to be clear, that's on the monthly, the doji
monthly
you're talking about on the hanging man, and that's and we've got a monthly demand indicator.
And this month is the 9. The 9 was a 9 trigger of a 9-13-9 monthly sell signal. And so when you have that kind of long-term trend exhaustion signal triggering at the same time, we've had these breadth warnings and a number of other things. I think the fundamentals are saying, potential risk, technicals are saying that risk could materialize. And then you look at sentiment, right? And we see, if you look at commitment of traders report, asset managers have, extreme long positioning, money managers in the COT report. You look at leveraged ETF assets, it's about as, it's higher than it was back in late 2021. And the leveraged long to short assets is about as high as it was, that ratio. So people are positioned very aggressively. We've seen those flows into short vol ETFs. We've seen flows into these single stock levered ETFs and NVDL and things like this. And so positioning is very extreme. Sentiment suggests that sentiment is extreme. And then the macro stuff we've kind of been talking about already. So you have those 4 legs of the trading table that are all kind of, I think, saying right now, time to be cautious. And I haven't even gotten to the insider stuff yet, which is kind of confirmation of a lot of this stuff too.
Well, let's come to that in a sec, because I mean that's a powerful setup. So, to your mind, the macro is pointing to concern, whether it's the inverted yield curve or a number of other ways of thinking about it. The technicals are nicely set up because the breadth signals are coming through, and as you say, the stock participation in this move is not good. And you've got a bunch of stocks at 52-week lows, even though the market's at a high, which sort of tells you the setup's not terribly strong. And then I guess you've got an expensive stock sort of concentration in there, and very strong sentiment and very strong flows into these areas of the market. What makes you nervous about this call, though? What makes you think it's perhaps not 100%?
Well,
nothing's 100%. Nothing ever is. Yeah, one's always nervous. I always say to the guys in the office, the more nervous you are, the better, probably. The more it feels
I think the thing that would make me nervous about it is there are so many structural things that have been going on in the markets that can, over the short term, overcome, all of the things that I'm talking about, right? And a lot of these things, structural dynamics in the markets are just, passive flows, right? We've seen, money just comes into the market regardless of what the fundamentals look like. We've seen these kind of value price agnostic strategies like the basis trade and the short volatility trade, and things that and seriously just the gamma squeezes that we've seen where traders just pile into short dated call options and drive prices higher regardless of what's going on with the fundamentals. And so these structural dynamics have the power to just drive things in the short term so far away from what might be a more important driver of kind of intermediate term returns. And so that's absolutely what makes me nervous. I'll point out there's one other thing that I pay very close attention to, and that's a measure of risk appetites that I look at on a daily and weekly time frame. And this is kind of just comprised of things like, all the general things that you would normally come to mind, high beta versus low volatility, discretionary versus staples, corporate spreads. I want to see bid-ask spreads in things like SPY and QQQ. What's Bitcoin doing? And then how is volatility trading? How's the VIX trading relative to the S&P 500? Because A lot of times we've seen recently, when the stocks are rising and VIX is rising at the same time, a lot of times that's pointing to an unsustainable short-term move in the markets. And we've seen that happen actually a lot recently, and it's a sign of these gamma squeezes, right? The people are chasing the, call options so massively that they're pushing VIX up at the same time they're pushing up prices. And that's a
Yeah.
sign that potentially an unsustainable move. So what we've seen, I think, over the last month, like you said, July 11th, extremely important in terms of my measures. We saw a dramatic shift in risk appetites that has not been rehabilitated in this rally. And to me, if you want to see this rally sustainable, you need to see risk appetites really rehabilitated. And that means, corporate spreads coming down, bid-ask spreads in these major ETFs coming down, a real, move back into these high beta names, and a real move back into kind of discretionary versus staples, and all these kinds of signals. And we just haven't seen that. And so, and if we do see, risk appetites, start to turn risk off again, that'll be a very clear signal to me that this rally was a classic, failed rally, dead cat bounce. And so, that's something I'm paying close attention to also. I think that in and of itself is maybe one of the most important kind of timing signals there is.
That's very interesting. I think that's fascinating because it strikes us that because obviously the typical pullback, whether you're beginning a bear market or it's just sort of a mid-cycle correction, tends to have the ABC shape or the 1, 2, 3 wave. And as you say, we've just had it looks like we've had a relief rally. The jury's still out, and
Right.
and normally you'd expect a third wave of selling. It's just been quite a strong relief rally, and I think that surprised people. It's gone on perhaps a week longer than it might have. It's pushed through key resistance levels. But there's another thing that may be going on because, for me, this is one of the key questions in markets at the moment, sort of in a way similar to what you're saying. But, I think we're rotating leadership away from the Mag 7. I think we probably all agree with that. It looks like that from a technical point of view, and there's a number of other factors that you've articulated that support that. And the question to me is whether we're rotating, and I always think about the stock market as cyclicals, defensives, and basically long duration growth, kind of 3 sectors. And it looks like we're rotating potentially to cyclicals or to defensives. And of course, that is all about your call on the macro, I think, because, historically, the first Fed rate cut in a soft landing is the beginning of a new bull run. The first Fed rate cut in a recession is the kick start to the bear market. So, and of course, in bears you go defensives, in soft landings you go cyclical. So, would you see that as a possible? When you look at the internals, would you say it's clear that it's just moving more defensive, the market? Would you say the jury's still out? Maybe it's moving cyclical since July the 11th.
I mean, it's a great question, and to me, I just think back to that 2000 timeframe, because that was a relatively mild recession that we saw, and it was a great time to rotate into things like small caps and value. And so, it wasn't this. I think when people think of recession and bear market, what's in our minds is 2008, right? Which is just,
Yeah.
great financial crisis, everything goes down, there is no rotation, it's just sell everything. And that's not kind of the type of environment that I think is very common, right? If you look back at, historically, these types of recession environments, that's an outlier. And so I do think, what we are more likely to see is some type of a rotation. Maybe more along the lines of that kind of relatively mild recession in the early 2000s that allowed for a rotation into value. That's kind of what I'm seeing from, just a lot of the other indicators that I look at. And it's really, really difficult because you look at, like, there's signs that, transportation's been really weak, but, trucking, is potentially in a, turning, and bottoming out. And, you read some conference calls and, like, steel industry and these types of things, and they're talking about potential strength and a lot of that is driven by a lot of the fiscal stuff that we've seen going on. So it comes back to the macro that there's this huge fiscal impulse in investing in infrastructure and reindustrialization and things. And so, that could probably drive, a cyclical rotation as much as a defensive one. So I think it's an important point that you make.
It's a fascinating point, actually, because this whole debate in the last couple of years, this idea that is the economy distorted by the pandemic such that we've had rolling recessions, with that whole situation reinforced by all this fiscal stimuli you've had out of the States, in particular the big four packages, including and since the pandemic. And I think that's kind of interesting because we go back to 2023, everyone's recession indicators said recession. It didn't happen in the US. The US surprised positively. But of course, most people's recession indicators are monetary based. The yield curve is a monetary indicator. The housing markets are and actually, of course, that fiscal, those fiscal push, the fiscal dominance idea, highly unusual at this stage in the cycle. So no parallels. So you're right, it's difficult. The macro is very difficult. So
absolutely,
I think it's a really tough gig at this point. It's interesting. We've been working on the Sahm Rule today. Everyone's going on about the Sahm Rule triggering. I'm sure you're familiar with that one. Unemployment more than half a percentage point and above its 12-month lows, and that's been triggered in the last month or two. If you do a state-by-state Sahm Rule, it gives you a completely different answer, which is that actually in December, it looked really bad state by state across the 50 states. The Sahm Rule was shooting up. 40% of states had triggered in December. Now we're down to about 15% of states, and none of the big four are in there. So again, another layer of confusion that we're all going to contend with, which is why your technical market indicators are really fantastic, because they're individuals voting, aren't they, on stocks that have a cyclical message. So I love that stuff. You're right, it is complicated. It's not easy. I have one other question for you, that whilst you're on that you made me think about as you were talking. The Buffett indicator, the expensive market. And then I think you touched on the idea of liquidity. I've always been of the view that markets are driven by liquidity, and I think that's a commonly held view. And of course, we live in a world post-global financial crisis where liquidity is just abundant. So it kind of seems logical to me that markets should be expensive. Now, I'm not doing an Irving Fisher here, saying they're at a permanently higher plateau. That great quote. But I just wonder how you fit that in, because when we started in this game, that wasn't no one really thought about it.
Yeah. Well, I think, to me, the reason that stocks have remained expensive on the, Buffett yardstick is the fact that profit margins have been elevated for longer than anybody would believe was sustainable. In fact, Buffett, when he first wrote about the Buffett yardstick in 1999 and 2001 in a couple of kind of op-ed pieces for Fortune magazine, he mentioned that even at the time, he thought profit margins were elevated beyond what was sustainable. And he said, if one segment of the economy, is going to take more share of profits than another, and we're talking about capital versus labor here, it's going to create, it's not sustainable because it'll create political problems. And so it's proven more sustainable than he obviously imagined, but we're now seeing the political problems that are rising because capital has taken, too much share relative to labor, and profit margins have remained elevated. But when you look back at what is the single most important driver of profit margins, it's been interest rates. And so the ultra low interest rates and cost of capital for companies has really been the thing that has allowed profit margins to be as high as they are. So if you believe we're going to go back down to ultra low interest rates over the next few years, then you can believe that profit margins are sustainable. And they have been for the last few years, because in 2020, right, everybody went out and just termed out all their debt at the lowest interest rates in history. And so it hasn't been a problem, and we've seen profit margins go stay at very high levels. But if interest rates, if we've ended a period of low interest rates, and I think there's a lot of arguments on both sides, I kind of just from a technical perspective, you look at the trend of interest rates, and we broke out of that in 2021, 2022. To me, that tells you this era of disinflation and low interest rates is over, and we're in a new era of relatively higher interest rates. And over time, that should work on bringing profit margins back down. If you believe that, then you have to believe too that the valuations, which assume profitability is going to remain at its current level indefinitely into the future, those valuations have to come down if profitability is going to come down. So I think those are long-term dynamics, but I think they're really important to pay attention to, because the price to earnings ratios and everything that people are looking at today absolutely assume profitability is going to at least stay the same, if not improve in the future. And if you believe we are in a new era in terms of what is the neutral interest rate and things like this, then profitability probably is going to have to come down over the next several years, just generally speaking, in terms of the higher cost of capital to businesses. And so I think that's a dynamic that's probably underappreciated by investors.
Yeah, that's very interesting. Of course, in many ways, it kind of squares the circle on the question I had, which is, to do with liquidity creation and causing high valuations. Because, when interest rates are low, you get more liquidity creation. When they're high, you tend to get less of it. So it kind of feeds on itself in a sense. It's a sort of three-way sort of three-pronged point.
Absolutely, and that's kind of what I didn't explicitly say, but that was kind of implied in my, if we are in an era of higher interest rates and inflation, it's going to be more difficult for the Fed to provide that type of liquidity to the markets that they have done over the past decade.
Yeah, and of course that feeds into the idea that there's more fiscal push these days, and therefore monetary policy has to be a bit tighter, interest rates higher, and so on. So it all adds up. The other thing I was going to say, I was wondering if you also referring to there was a great Fed study a couple of years ago now, comparing EBIT growth and profit growth at those two different levels, and sort of pre-1980 and post-1980, and showing that the growth rate had doubled in the last 2 or 3 decades as interest rates had come down, and therefore the I of the EBIT, and as tax rates had come down as well. And as you say, maybe both are now trending up. Excuse me, which I thought was a fascinating study. I don't know if that was part of your thinking, but it's certainly
no. I think the tax rate issue is another one, right? I mean, this is why the there's a big political question right now that whoever wins the presidential election, has a chance to really change corporate tax policy. So but generally, when you isolate the main drivers of profit margins over the last 40 years, interest rates make up the largest share of that profit margin change over that time.
Fascinating. So let's switch it up and get into first of all your key ratio. You mentioned the insider buying, selling, and then perhaps a couple of stock ideas at the moment.
Sure.
Talk to us about that ratio.
Sure. Yeah, I kind of did before. If there were one indicator that I were to kind of prioritize or look at above in all others, it's going to be what are the top executives in corporate America doing with their own money in their own shares. And Najat Sehoon, who's University of Michigan Business School professor, has really quantified looking at this stuff better than anybody I've ever seen. And he's demonstrated that when you can look at it in aggregate, this insider sell-buy ratio has a very good 12 to 24 month lead on earnings, on economic activity, and on stock prices, obviously, because they follow the fundamentals. So, when insiders are very bullish and, buying a bunch of stock and not selling very much, that's a really good sign that earnings or over the next 12 to 24 months are probably going to surprise. The economy is going to be good, to the upside, and vice versa. So what we've seen over the last 12 months is that this sell to buy ratio went over 25 times, which the only time that's ever been that high was in about November of 2021, which ended up being a great indicator. Insiders pointing out that, okay, earnings growth that people are expecting is not going to materialize in 2022. Stock prices are not going to do so great. And we might actually head to recession. The recession didn't materialize. But insiders are saying the same thing today that they were saying in late 2021, which is earnings growth is not going to live up to expectations. Economy is going to be weaker than expected right now, and stock prices are likely to trend lower over the next year to 2 years. And so from a macro standpoint, I think that's a very valuable confirmation of some of the other things that we're looking at and talking about.
And where do you find this information? Is it publicly available? I know in IBD, I think, produce one, don't they? There's one or two others maybe.
Yeah, so I thank you for asking that. I have to give credit to my friend Asif Surya, who runs InsideArbitrage.com is his website. And what I like about his data is it only includes true insiders. He doesn't include 10% shareholders, which file trades just like insiders do, but are not nearly as meaningful as corporate executives and directors. And so his measure is just executives and directors. He publishes it on a weekly basis, the total buy and sell. And it's as I said, it's one of the more valuable things that I look at.
Fantastic. And I think the top level charts on your website, if I'm right, if people want to check it out,
Yep.
felderreport.com.
Yep.
So do you then use this on an individual stock basis? I believe you do, and therefore,
Yeah.
what kind of, you got a couple of stock ideas you want to share?
Sure. Yeah. And so for me, I should say, I probably should have said this at the opening. I never let macro concerns get in the way of taking advantage of micro opportunities. I'm a value investor at heart. And so when I find stocks that kind of tick those four legs of the trading tool, a cheap stock with good technicals, very bearish sentiment, and maybe fits into a kind of a macro theme, I'm buying the stock. And those are the types of things that I look for. A lot of times my idea generation just comes from the insider buying and selling. So this is something that I've followed since back in my days of Bear Stearns, is kind of looking at what are these executives doing with their money. And I'll just point out, NVIDIA announced earnings yesterday, and Jensen Huang has sold $500 million worth of stock in the open market over the past 3 months for the first time in his career. He's always exercised options and sold shares to pay taxes and things. These are the first open market sales that he's ever made as CEO and founder of this company, which to me is a big hint as to where he thinks we are in this AI cycle.
Yeah.
But I would just point out
would you look at the price pattern of NVIDIA and I mean it's sort of it's around its 50 day at the moment. It's not obvious it's in a good technical price condition. What would you observe on that?
Well, it reminds me of I'm forgetting his name, famous Merrill Lynch strategist who came up with 10 rules, Bob Farrell. Stocks that go through a parabolic ascent don't correct by going sideways. And so I think to me that applies to NVIDIA more, at least as much to any stock that I've seen, that this has been a parabolic ascent. And it's not going to correct by moving sideways for a number of years. Momentum in this one is critical, and momentum has been waning for the past several months, which is a very clear and really that makes perfect sense. If you think this stock is being driven by all those people buying 0-day to expiry call options and leveraged 2 times leveraged single stock ETFs and these types of things. Those types of traders run out of patience when the stock stops going up. And if they start to run out of patience, and they've poured so much money into these products that they start to liquidate, that's how you get a correction that is just as
the marginal buyer.
The ascent was.
Buyer.
Exactly.
Yeah.
Exactly.
Okay, so sorry. So that's NVIDIA.
Yeah. So in terms of some of the other stocks that I've looked at recently, I wrote about Carvana a couple of years ago when the insiders there, the Garcia father and son tandem, were buying massive amounts of stock. Right, the stock sold off massively, thinking it was going to go in late 2022. People thought it was going to go bankrupt. I've bought and sold a couple of cars through Carvana. I love it as a consumer. It's the best experience I've ever had. So it's a stock that I was watching.
Second-hand cars, isn't it? Second-hand cars,
Yes.
or is yeah,
Yes.
all second-hand, right?
Yeah.
Okay, yeah.
All used cars.
And it's a sort of website type approach. Is that
It is, and
that
they
correct?
have these big car vending machines that you see on the side of the freeway and things that are great marketing. But essentially, they
Right.
make it so easy to buy or sell a car that it's silly. I mean, it's like worlds better than going to a dealership and dealing with that whole nightmare. Um, so when the Garcia, Ernie Garcia Jr. is the CEO, and his father was one of the largest shareholders and kind of funded the company. Family history of operating in the used car business. We're buying literally tens of millions of dollars worth of stock, around $20 a share. Ended up falling down to $4 or $5 a share. It was a great sign that they had a lot of confidence that the company wasn't going to go bankrupt. And when it came clear that they were able to kind of come to terms on with debt holders and things, they weren't going to go bankrupt. The stock went nuts to the upside. Now, I'll point out it's gone from literally $5 a share to $150 a share. And
Wow.
and now
They made a lot of money.
Ernie
They've made a
Garcia
lot of
Sr. has been literally selling all of the stock that he bought 2 years ago and then some.
right.
So
So this one's done. This one is done
yeah,
from your
I think
methodology.
if you were to ask
Yeah.
the Garcias, yes, they're telling you with their actions that the stock is done and it's time to take profits here. So
Well, if they're buying at 20 and selling at 100, 120, their 10 million is 50 or 60 million. So I'm not surprised
yeah,
they're taking some profit.
absolutely. And this is where, I think I'm surprised people don't pay more attention to this stuff, because there are certain insiders at certain companies that are just fantastic traders of their own shares. And, there's a handful of companies that I watch. Ulta is another one that Warren Buffett started buying, and the insiders there, when they buy, it's a great indicator. I haven't seen insiders kind of come in to buy stock there at Ulta yet, but it's another one where the insiders have an unbelievable track record. And so to not pay attention to that, you're really missing out on one of the most important indicators of what's going on there.
What's the ticker
Another
for Ulta? What do they do? What's the ticker?
Ulta is a cosmetics retailer, so they have a
Oh,
chain of
with a
stores.
U. I'm with you. I'm with
Yeah,
you.
yeah.
Ulta. Yeah.
Um,
Okay. Yeah.
and yes, and so Berkshire Hathaway recently took a stake and the stock popped. It's one that's kind of on my radar because when insiders start buying it, it's a good sign that business is doing better than analysts expect and whatnot. And so this is a tool that I think, if you're a value investor, can be really, really helpful. I mean, to me, I use the insider action to confirm my thesis of whether this is a cheap stock and undeservedly cheap. If the insiders are validating my opinion, fantastic. If they're not, then I'm more inclined to kind of stay away. But another one
Okay.
that
So
I've go
to
ahead.
understand, just to understand your process a bit more on single stocks as a value investor. So you're doing that sort of classic value analysis. What's the company like? What's it probably worth? Is it cheap relative to intrinsic value in the stock market? And then you're looking for validation from the buying by insiders,
Yeah.
basically.
Well,
Yeah.
and a lot of times, like I said, the idea generation will come from the insiders, and then I'll look at the valuation and things and go, "Wow, this thing is trading at its lowest price to earnings ratio in history. What's going on?" Oh, well, they missed their numbers last quarter, whatever. But when you listen to the conference call, they're saying this is a 1 quarter thing. We're going to turn things around, and they're putting their monies where their mouths are by buying stock in the open market. Um, One where that's happening right now, it's not one that I own, but Ballcorp, which is a major, it's one that I bought actually in the early 2000s, one of the best, where insiders have been really predictive there too. Maker of aluminum cans and glass
Oh,
jars
yes.
and things, and they have a lot of other industrial businesses, but about as boring an old economy business as you can think
Yeah.
of.
Yeah.
Um, but when the
I remember
insiders buy
Ballcorp.
there, what's that?
Well, I was going to say, I used to be a US equity analyst in the mid 90s. And I
Okay.
used to, there was a aluminium can company. I can't remember what it's called. It wasn't called Ballcorp, but it was the
Okay.
biggest in the group. Well, I used to look at it.
Yeah.
But
Well,
it'll come to me anyway.
back in the late 90s, when the dot-com bubble was going nuts, Ballcorp was left for dead. And it was a fascinating story because Bill Stieritz, who ran Ralston Purina and was literally the most successful executive of like the 80s and 90s, was hired to take over Ballcorp. And from his track record at Ralston Purina, you can say, oh, wow, if this guy can do what he did at Ralston Purina, Ballcorp's going to be a great stock because it was trading single-digit PE. He came in and he bought about 50, $60 million of stock with his own money, brought in his whole executive team, and they all bought, literally 200, 300, 400 times their annual salary in shares. And there wasn't a clearer sign of confidence that
Yeah,
they were going to be able to do at Ballcorp what they did at Ralston Purina. And Ballcorp went up from 2000 to 2015 or 16, went up 20-fold. And so
fantastic.
those are the types of
Yeah,
opportunities where, like, if you're paying attention to this guy is one of the greatest CEOs in American history, and he's literally going all in on his own stock. Okay, I have to have a position, right? Like,
yeah.
just to kind of pay attention to it, see what happens. So, another
And
stock
you're
that,
saying they're not buying at the moment. They haven't started buying at
no, at
Ballcorp yet.
Ballcorp,
And I assume it's a different CEO as well, a different
no,
CEO now, I
as
guess.
it is a different CEO. Bill Stieritz is long retired. But for a while there, he was on the board of a couple other companies, and I actually Post Holdings was one where I think he was executive chairman, and he would buy stock in Post, and it was a really good indicator that that stock was undervalued. It's new management team there at Ballcorp, but in the last, I think they had a disappointing earnings result last quarter. They did say during the conference call, CEO, CFO was going to buy stock in the open market the next day, and they did follow through on that. And so that's kind of an interesting thing to kind of pay attention to, especially
Yeah,
with that stock's
interesting.
history.
Let's get some Ballcorp. Okay, I
Yeah,
like it.
that's not
And
one
you
that I've
said there
written
was
up as
one
as
more.
a
Was
trade
there
idea.
was there was there one more you had? I thought you had one. I interrupted
Sure,
you and you're about
there's
to go into one
yeah.
more.
So I think, to me, one of the things that as a value investor I like to think about is what's the most hated asset class on the planet, right? And I think
Right,
right
yeah.
now it's probably a tie between energy, but I think probably outweighing it are Chinese equities. I think Chinese equities are probably the most hated asset class on the planet today. And so recently I saw a cluster of insider buying at Yum China, which is essentially the largest restaurant operator in China. They operate Kentucky Fried Chicken, Pizza Hut, and Taco Bell, a couple other brands there. I think they've got about 15,000 locations in China. And they're growing at about 1,000 new locations a year or more.
Yeah.
And the stock trades 14 times earnings, no debt at all, which is kind of rare for,
Wow.
you look at McDonald's and
Yeah.
they've got tens of billions of dollars of debt. So no debt on the balance sheet, trades 14 times earnings, and the insider, that's the lowest valuation since it was spun out of the parent company Yum Brands, which is kind of the bigger, American-based company. So insiders here were buying. Last time they were buying in kind of a cluster like this was 2018. Stock doubled or tripled after their purchases. So here's I think a very interesting idea where you have a very cheap stock trading 14 times earnings, growing at least 10, 15% a year. They're using all of the free cash flow to either open new locations or buy back stock at these valuations. And all the top managers of the company are buying shares in the open market with their own money. It's a very, from a contrarian standpoint, it's a very compelling opportunity.
And technicals, it's just trending up the stock, or it's turning, or for those that don't know.
It's been in a downtrend, but if you look at back to when it, and I think was it Bruce Greenwald, I think, did a study on you can be a stock market genius. Am I remembering his name correctly? Spin-offs. This is a spin-off, and spin-offs are really a good area of value opportunity for investors, because what happens is companies spun out of the parent company, and investors that hold Yum stock were like, okay, well, I don't want to own Yum China. They just sell it, and so you get a lot of just
Right.
systematic selling that depresses the shares
Yeah.
over a period of time. So it's essentially right back to the price that it was spun out of in 2016, 17, essentially shares have gone nowhere, even though earnings have doubled or tripled over the last 7-8 years. So I think there's a good technical, support level, right about long-term support level where shares are at now.
Yeah.
And momentum, that downside momentum has been waning, which to me is something that I kind of require as a value investor. I don't want to buy something that
Yeah.
has good downside momentum. So
Yeah. You don't want to catch a falling knife. You want a cheap stock that's turning or
absolutely.
bottoming or whatever. And do you look at volumes as it's sort of trying to trough as a good indicator? If it's popping up from a trough, is a strong volume day or week or month a confirmatory sign for you?
Volume is not something that I pay close attention to. To me, those trend exhaustion signals and momentum are really kind of the main things that I pay more attention to. I will look at from a momentum standpoint, and I have to give Michael Oliver credit for the way that I look at momentum. I think he's developed something that's just kind of unique and brilliant. And so from a momentum standpoint, you can see where the kind of momentum channels, an area of weak momentum. And one of my favorite technical analysis quotes, because it's just so simple, is Paul Tudor Jones has said, when you see a security or price break out of a range, in a way, it's a very loud, clear signal that prices are going to continue in that direction. And so, if you apply that to momentum, you get these momentum structures where a downtrend just appears as kind of just weak momentum for a period of time. When you can break out of that momentum structure, it's a clear sign that, okay, this downtrend is done, and price might not represent that as clearly as momentum does. And so, yeah, I'll look at not necessarily volume, but I'll look at momentum to kind of confirm that, okay, we've seen a change in momentum in the other direction, that is a positive sign that the trend is shifting in the right direction.
Fantastic. Wow. Well, that's fascinating. That's a wonderful trip around all sorts of things. Some great stock ideas. Great to talk about markets, and I love hearing about the way you go about life. So I just want to say thank you, Jesse, so much. I really appreciate your time. And I guess if people want to learn more, head to the felderreport.com, and maybe to your podcast as well, I guess.
Yeah, the podcast has been on hiatus for a little while. I've just been lazy about it, I guess. But yeah, the
Yeah,
felderreport.com is kind of where I publish everything. And there's a free weekly report that I put out that just highlights charts and links and things that I come across on a weekly basis that I think are especially valuable.
that's fantastic. I really appreciate it. Thank you for your time.
This was great, Chris. Thank you so much for having me. I really enjoyed it.
Pleasure. Thank you.